Sure. All right. Well, if you guys didn't hear Marissa talking a little bit earlier, we just wanted to welcome you guys to our Homebuyer Seminar. We're the Bus Lampert group of Aviara Real Estate, and I think we know most of you guys, but we're really excited that you guys are here, taking the first step to learn about the process of buying your home, and we're really happy to help in any way that we can. If you didn't hear Marissa talking earlier about questions, there is going to be a question and answer portion at the end of the presentation, but feel free to enter your questions into the chat or the Q&A portion of the Zoom. If you're on your cell phone and that's a little bit tricky to do, you can always text me questions or text one of us questions and we can discuss them at the end. We also have Kara Buss from Logix Credit Union, and we're so happy to have her because she's going to go over all the financial information. So we'll go ahead and get started. So you've already made the decision that you're going to be buying a home, and you want to know kind of what the first step is going to be like in working with us. And so the first step is going to be finding a house. And what you'll do is sit down with us. We'll go into depth and detail about kind of what you're looking for, what your situation is like, and then we'll set you up on a search. So what that does is basically send you all the listings as they come up in real time that match with what you're looking for. And then we'll go and see a couple of those homes if you're interested in any of those. What's a little bit different right now with COVID is there are a couple little extra procedures that we have to go through to be able to show homes, which basically includes you signing a form for each home that you see. It's called a PED form. And that just talks about the fact that, you're saying you don't have COVID, the seller is allowing you into their home, just kind of a liability form. And then that you're going to be cleaning after we're going to be cleaning after you see the home, and that you're going to disinfect it going in and out. And so because of that, also what we're doing right now is basically making appointments. So I think we've been seeing some open houses kind of getting around that, where they're just allowing people in, but then cleaning in between. But for the most part, we're doing appointments right now to see homes and getting that PED form signed before we can see it. So what happens if you find a house that you like? Well, if you find a house that you like, then you're going to make an offer on that house. Right now, people are making offers pretty quick because if you haven't heard already, the market is pretty crazy. There aren't a lot of homes on the market right now, but there are a lot of buyers who want those homes. So you've got to act pretty quick. And then you'll sit down with us and we'll help you make a really strong offer so that you can get that offer accepted and get that home that you're looking for. On that note, because it is a multiple offer situation right now, people are offering above listing price. So they're offering more than what the house is selling for. They're also doing things like waiving contingencies, which we'll talk about a little bit in the next slide, what those contingencies are. But that's all just to make your offer look kind of sweeten the deal and get your offer accepted. And then once your offer is accepted, within 3 days, you'll put down an earnest deposit, which is basically just like your good faith offer that you want to buy the home, you like the home, and that's usually about 2 to 3% of the sale price of the home. And so next, we're going to talk about what 3 contingencies in an offer are. So those are the physical inspection, the appraisal contingency, and the loan contingency. The physical inspection is basically when someone comes to look at the home, looks for damages, and then you would negotiate the repair of those damages with the seller typically. The appraisal is when it's ordered by the lender and the home is appraised. You check out what the value would be on the home. And typically that contingency protects you from being locked in if there's a difference in what the home value is appraised for and what it's being sold for. Typically, that's just a general description. And then the loan or financial contingency basically allows the buyer to back out if they can't get a loan that's big enough without losing their deposit. So those are some of the things that are, some or all are being waived in making someone's offer look a little bit more appealing in getting it accepted. And next, Marissa's going to discuss inspections on a home. You're muted, Marissa.
Okay, here we go. So what inspections are you going to get on a home? And I'm sorry if you can hear my dogs. I just asked for them to be put away. But there's 3 inspections that we generally advise for people to get. You're definitely going to want to do a home inspection, and that's where a home inspector is going to spend 2 to 3 hours in the home going through it top to bottom. If it's a raised foundation, they crawl under the foundation, inspecting all of the piers and all the plumbing and all of that. If it's a concrete slab, then they're going to be going through the whole house up into the attic and ensuring that they don't see any water spots from the roof that may, or water stains. Checking for termites. They are not termite inspectors, though. That is a different one that you want to get as well. But they go through the whole house, and then they go with you and walk you through the home and let you know the things that they see, what are health and safety issues, if there's any code violations, if things are not up to code. You see a lot of that in the older homes because they were built in a different era. So if they've been remodeled, it will show, he'll go through and let you know, well, they didn't, when they remodeled this, they did not put it up to code. So different things like that. They're going to inspect your water heater, tell you how old it is, if it's all done to code and permitted. They're going to let you know about your HVAC, your heating and air conditioning, which is another one of your big costs. So they're going to inspect that, make sure that it's working properly. They have little temperature guns that they are registering and seeing, making sure it's cooling below 14 degrees difference, as well as making sure that the heat's coming on and has that variance that they're looking for. If the house has a pool, they're going to go through all the pool equipment as well and make sure that the motor is working, the filter is working, that it's not leaking. If there's a heater, they'll turn on the heater, make sure that the heater turns on. If it's a spa and there's, jets and all that, they're going to make sure that all those things are turning on and working. So the other inspection that we recommend, depending on the age of the house, we recommend a sewer lateral inspection. And this is actually a sewer inspection that just inspects the main line of the house. So there's usually a clean out in the front of homes. If there's not, they go through the roof, but they go down and they inspect from the front of the house all the way to past the street. And they're looking to make sure that there's no roots that have gotten into the pipe and that it is draining clean and that water is flowing correctly through it. That's a very expensive repair if you have to do it. They're generally, if you have to replace your main line, it's usually $8,000 to $10,000. So that's why paying the extra $250 for a sewer lateral inspection is very important. Basically, if the house is 20 years or older, we generally recommend, or if we see a large tree in front of a newer home, we recommend you get one. The third inspection that we recommend is a termite inspection. And this is they're going to go through the whole house. They crawl through the attic, all through the interior and the exterior, and they're checking the eaves for dry rot. They're making sure there's no active infestation if the house has to be tented. So these are all things that we want to know, because if the house has to be tented, it has to be on for 3 days. So you want to have that done before you move in. So that's one of the ones that we also recommend for any age of a home, because termites can be, it doesn't matter the age of the home if there's active infestation. All right, and the next slide we're going to move to. So the appraisal. What is an appraisal? An appraisal, if you are getting a loan, if you're doing all cash, people don't generally get appraisals. They kind of just look at it and see the value in it, and they offer what they feel the value is. But when you're getting a loan, you're going to get an appraisal, and the lender orders the appraisal through a third-party company. So they do not work directly for the bank. They are a third-party company, and when they order that, the appraiser comes out, and generally the listing agent meets with that appraiser and provides them with recent sales in the neighborhood to try to persuade them of the value of the house. Now, in our current market, with the values going up so quickly, we are having a lot of issues with appraisals not coming in at the purchase price. And there's 4 options when this happens. Number 1, the buyer can bring in cash. So let's say you purchase a home and you said, I'm going to pay $750,000 for this home. And your appraisal comes in and it comes in at $725,000. Well, if we cannot convince that appraiser because we found some other comparables that make them see the value, then that buyer has the right to bring in that extra $25,000 to purchase the home. That is happening a lot right now if they get a low appraisal. But we also have been getting a lot of appraisers where they are seeing the appreciation that's going on in the market, and they are adjusting and giving us a little more leniency with bringing in values higher than they probably would in a more flat or declining market for sure. So the second option is, if it comes in low, that the seller can lower the purchase price to the appraised value. And so that is an option. The third option is that the buyer can bring in some cash and the seller can drop the price and kind of meet in the middle. And sometimes that happens. And the fourth is that if none of those work out, the buyer can choose to cancel their transaction and not buy the house. So you're not locked in if you get a low appraisal and you have to bring in that cash above and beyond your down payment and your closing costs. You can cancel if it doesn't make sense for you. So that is basically what the appraisal contingency is for you and what an appraisal is. So next slide. So next we're going to go and have Kara go into all about the pre-approval process and let you know what you need to know as a buyer trying to get a loan from a bank. All right, she's going to share her slides and unmute herself.
Hi, sorry. Okay.
So Kara works at Logix Credit Union, which a wonderful thing about Logix Credit Union is they do service their own loans. So one thing about that is that they can generally make exceptions that bigger banks that sell their loans to Fannie and Freddie Mac cannot make. They were going up to higher debt to income ratios before many of the bigger banks were, which was huge for people who are self-employed or have income that doesn't show up on their tax return. So they could really afford more, but they're not showing the income of it. That was really big for those type of people.
So first off, I want to reiterate what Angela said. Congratulations on starting this process. My part isn't very exciting, and I would say the part that people are most scared of confronting. I would argue, maybe Marissa would argue against, is that you should visit a mortgage lender first. That way you're not looking at homes online and getting all excited, and then you find out you can't afford those homes. But so this PowerPoint's just a brief overview of terms you'll hear when you're going to get your pre-approval done in order to see homes. So the first steps, I would say, even before seeing me, is to join a service like Credit Karma so that you're tracking your credit and making sure there's no lates that are being reported incorrectly, because those are things that can slow down the process. And in a market like this, you want to make sure that you have all your ducks in a row when you make your offer. Then there's the monthly payments. So I could qualify you for a payment, but that doesn't mean that you'll necessarily be comfortable with that payment. So you need to decide, what do I feel comfortably spending each month on my housing? And it's not just going to be your mortgage, it's also going to be property taxes and homeowners insurance, and sometimes what's called a HOA, homeowners association. And then set your price range. Your price range will be determined by the amount of down payment. So we can go as low as 3% up to certain loan amounts. And then the traditional is 20%, but the average, I think I just saw, is usually people put about 5% down on their first home. And then the next is consider possible lenders, so shopping for a mortgage. So I recommend checking at least 3 lenders. And that may sound funny because I am a lender, but it's important to make sure that the rate you're being offered is a market rate. And then also sometimes we compete with each other. So I work for a credit union. If you're a member of us, our credit union, and someone else, another credit union is saying that they're 0.125 lower than our rate, we may just say, okay, we'll go down the 0.125. It doesn't always happen, but it's just good to know that you're getting the best rate you possibly can. So I would say to check with 3. So there's different types of lenders. I'm a direct lender and would fall under the banker category and originator. There's brokers who work with multiple institutions and private lenders to get financing. There's pros and cons to all of these. So that's why I say check around and then go with who you feel most comfortable with, because you're going to be financially naked in front of this person. And then again, the credit review. So if your credit isn't perfect, don't think you can't buy a home. You should definitely have a conversation with someone that you trust, or have a trusted referral from a friend. And what I do for my clients is that I will let them know what they need to do, what steps to take in order to be in the position to buy the home. So for instance, I had a client that I ended up working with over a year. And I have people where it might take 2 years, but we just, I think homeownership is the easiest way to attain wealth for, the average person. And so I'm really passionate about helping people to get to that point. So here's some commonly used mortgage terms that you'll hear. Debt to income ratio is a ratio we use to determine whether or not someone's qualified for a particular mortgage. What we do is we take the gross monthly income and the debt that appears on the credit report, the monthly payments for that debt, plus the housing costs. So what I previously talked about, which was the mortgage payment, the taxes, the homeowner's insurance, and sometimes HOA, that cannot exceed 50% of your gross monthly income. So that goes back to when I was saying I can qualify you for a payment, but you might not want to spend 50% of your gross monthly income on your house. Down payment is just the amount of money that you're bringing in. Big misconception, I think, is that you can't use gift funds. They're perfectly fine. So if you have a family member or someone close to you that wants to give you some money to put down on a house, we don't need you to deposit it and have it in the account for 2 months. That used to be like a common misconception. We just ask for a letter from the person who's providing the funds, and that's a-okay with us. The only time it may become a factor is if you're putting less than 20% down on certain types of loans, you need to have some of your own money in there. So for instance, if I'm putting 5% down, a lender may require that part of that 5% comes from my own funds. So that's just a conversation you would have with your loan officer. Private mortgage insurance is frequently referred to as PMI. And when you put less than 20% down, you are required to have this unless you're in a different loan program called an 80-10-10, but that's for another day. So what private mortgage insurance does is it helps protect the lenders, because you don't have as much quote unquote skin because you didn't put such a large down payment on the property. The view is that, oh, this person might walk away if this property declines, etc. And so the private mortgage insurance covers the lender. Once you achieve 80% equity, you can have that, or 20% equity, meaning if I buy a house for $100,000 and say I only put $5,000 down, but 2 years later, my house is, now worth the 20% more. I don't know why I set myself up on that math problem. So then you can have that removed. And typically what happens is you can have, like with us, with our private mortgage insurance, we would just appraise the property and then remove that monthly fee. It is a write-off for certain people. That changes year to year though. One thing I will mention is with FHA loans, right now it's fixed for 10 years, whereas with Logix, we can remove it sooner than 2 years if you have the appreciation on the property. But it's not like you're forced to have that PMI for 10 years, which can kind of be pricey depending on the situation. And then interest rate is the rate of the loan. So you'll hear interest rate and APR, which I'm surprised I didn't put APR in here, but so interest rate is the face, what they call the note rate. So I have a loan for 1%, and then I have to quote the APR. And so say the APR is 1.12. What that represents is all the interest, if you keep the loan for the term, calculated in to give you a true interest rate. So in reverse, when you have a savings account, they'll quote to you your rate and then your yield. And so in lending, it's your rate and then your annual percentage rate. Super exciting stuff. Okay, so when you're shopping for a mortgage, we do the pre-qualified pre-approval process. Here's another thing that why you want to go with different or get quotes from different lenders is costs could potentially vary. I will say they don't really vary at this point in time just because it's very competitive. The recommendation is to know the lender, which I agree with because you're going to be sending all your personal information to them. Types of loans, we have conventional, which is usually your 20% down, but we can go as low as 5% down. There's government programs, VAs for veterans, which is a great program. If and you served and don't know anything about that, I would definitely look into it. And then we have FHA, which is a lender for, it's a program that's a government program that's for if you have a higher, like you're not the perfect borrower, I'll put it that way. And then jumbo loans are loans that are above a certain amount depending on the county. So in Ventura County, jumbo loans are any loans that are above about 740 and above. And that's my presentation. Thank you.
So we have a couple questions for you.
I'm gonna stop sharing just so.
And the questions are, what does the buyer pay you? Do you actually get paid by the buyer?
Oh, that's a great question. Okay, so the way my business works is my company pays me. So with the credit union that I work for, Logix, we set our rates and I make the same amount. I just make money based on funding loans and that's it. But with the broker, you could potentially pay, which is not really you're paying the broker, you're paying for the interest rate. So I could offer you a rate of 3% with no, they're called points. And then you can say, well, I want 2.875. And then we'll say, okay, well, you need to pay X amount for 2.75. Who really pays us is the conventional loans that we're spoken about. They are packaged as commodities and sold. So as mortgage-backed securities. And so our company, that's how they're making their money. I don't know if that's too much information, but there's a secondary market where investors buy up packages of mortgages and they pay a premium to the originators, which would be the lenders.
And then another question for you is, how much are closing costs generally?
So Marissa, you're good at this too. So for a purchase, what do you say usually, like 1%?
I usually say if you're not getting impounds, if you're in impounds, we should explain. Impounds are where you have your property taxes and your homeowner's insurance built into your monthly payment. Property taxes are only due twice a year. But for instance, we have a VA loan because my husband is a veteran, and you have to have impounds. So our monthly payment is larger than it has to be, but I don't have to come up with a large amount of money twice a year. So it's kind of nice They hold it all in an escrow account and then they pay it, and I don't ever have to worry about paying my property taxes. So if you have impounds, I always say that you're probably going to be closer to a 0.1% to 1.5%. And if you don't have impounds, I say it's usually about 1% of whatever your purchase price is.
And I should go back. So when we say closing costs, it's also prepaids. So when you see that big number and you hear 1%, you're like, what? But like what Marissa's talking about, you're prepaying your taxes. You're prepaying, like you have to pay a whole year's of hazard insurance. So if I eliminate like the prepaids, our lender costs are $2,500, about between $2,500 and $3,200 with appraisal. And the appraisal is going to the third party. Sometimes I can get a rate where we are giving a credit and that absorbs that. So the closing costs that are truly closing costs would be escrow, title, and those are third parties. So who chooses escrow and title is typically the seller's realtor, but it is negotiable. Right. But so that's a closing cost that when you're comparing lenders, in a purchase situation, it won't change between lenders because it'll be whoever you and the seller decide on. And so we have no influence on that. All we have is if we have an underwriting fee and then a processing fee. So that would be what you compare with the lenders.
Right. And then let's see, we have a couple other questions. This is a good one. Does the buyer pay their agent? So a lot of people don't know this, but when you are the buyer, you actually don't pay any of the commissions. You end up paying the commissions, which people don't realize too, when you sell the home. Mm-hmm. So the seller pays the commission for the buyer's agent and for the listing agent. So agents are completely free for you to work with as a buyer because you're going to pay for it when you sell. That's always kind of a rude awakening for a first-time seller, not a first-time home buyer. So that's where, the benefit in being able to use your own agent who knows you and is looking out for your best interest, because we are fiduciaries, and fiduciary means that we have to look out for your interests before our own and anybody else's. And I cannot tell you how many times as a listing agent, because I do about 75% of my business is listings every year, how many times I see buyer's agents that I can tell are desperate to pay their own bills and not necessarily really looking out for their clients. And it's really sad. So that's where you can use whoever you want when you're buying and you don't pay for it. So you really should use someone that you trust and that is going to work really hard for you and cares about you genuinely as a person.
And is knowledgeable.
Yes. And even if they're not knowledgeable, but they're working with people who are knowledgeable too. Yeah, so, that's when has a good team and has a good mentor. That's huge too. Yeah. Okay. So another question here is, what is something to look for in a starter home? So I think this is kind of it depends. So I get a lot of first-time home buyers who want to buy the cheapest house and fix it up, and not really realizing how expensive it is to actually do construction and how inexpensive your loan is right now. So a lot of times I feel like people go in looking for a starter home and something that is less expensive and that they are going to do the work on. And when we start looking at houses and I start explaining to them, well, every $10,000 costs you $50 a month, roughly. Right now, the interest rates are actually so low, it's probably less than that. But that's my general rule of thumb, is that so if you could go buy a house, maybe $50,000 less than what you originally wanted to spend, but then I say to you, but you have a house completely remodeled over here for $50,000 more, which is $250 a month that you just move in and enjoy. I'm like, just take the house, you move in and enjoy, because I don't know if you've ever remodeled, but it is not always the funnest process. It's kind of, especially if you have small children. that's not really the funnest process. So
And I would say location too, like location, location, location.
location is huge for a starter home for sure.
The
You
flip
know,
side on like what you're saying is I have a friend who they bought the most done house, but it was on a very busy street as opposed to a house that needed a little work on a cul-de-sac. And I would say pick the house on the cul-de-sac over a busy street just for your future resale. And if you want to refinance, it'll help with the value.
yes, yes, for sure. All right, let's see what else we've gotten here. Okay, so can you speak a little bit about a buyer's market versus a seller's market? All right. So in general terms, when we talk about it's a seller's market, that means that we have below 6 months worth of inventory. In our area right now, we have had below 3 months worth of inventory for the last 7 years. Basically, since about 2013, it really started to take off. 2010 was the low, and that was still a buyer's market, and they were, there were great deals to be had. And then the inventory started to get tighter and tighter and tighter as we had a huge hedge fund named BlackRock come in and start buying up. And now they are the largest single family homeowner in the whole country. And so that, with all the investors who bought up the inventory and created rentals, it has created a very tight inventory. Also, the lack of, in our specific area, Ventura County, the lack of new construction over the last really like 5 to 10 years has created where we have this bubble now due to having extremely low inventory. A normal market is where you would have 6 to 8 months worth of inventory sitting on the market. And a buyer's market would be where anything over 8 months worth of inventory. So we haven't been there really since 2008 to about 2012 was really the small pocket we had for buyers. It was still pretty competitive though, but that is the definitions of a buyer's market versus a seller's market. And so right now we are in a seller's market. They are able to command top dollar. They're still being, I would say though, pretty reasonable when you are asking for requests for repairs after inspection. A lot of them recognize that they're getting top dollar and they are willing to either give a credit for repairs or which when you get a credit, it goes towards your closing costs. So it actually lowers your actual cash out of pocket. So let's just say you're buying a $750,000 house, your closing costs were going to be about $10,000. So they may say, it needs a new AC condenser. That's $3,000. Well, I don't want to put it in. You deal with it. I'm going to give you a $3,000 credit. And then that lowers your closing costs from $10,000 to $7,000. Or they are doing the repairs before you close escrow. And then you just go in and inspect that they were all done. So that's the difference between a buyer's and a seller's market. And let's see. Okay, so here's a question we get quite a bit. So how much should you have saved before you start the process and waste a realtor's time? So first of all, you're never wasting our time. We love showing houses. That's actually the fun part of our job. So anytime anybody wants to go see a house, I am always game for it. And I think, there's really cool houses out there. Right now with COVID, it is a little more where some people are asking for a pre-approval letter in order to see a house. So what I say is you're not wasting a realtor's time or a lender's time. Okay. Before, a lot of times people really need to go through the pre-approval process to know, okay, if I pay off my car payment, which is $500 a month, I can then afford $100,000 more in a house. But you don't know that until you have someone like Kara look at your credit score, look at your credit, what's showing up, look at your gross income and say to you, okay, this is how much you're going to need for your down payment at minimum, 5%, or there's some 3.5%. If you're VA, 0% down. And this is what you're going to need for your closing costs roughly. And this is what you can afford right now. But or maybe you need to raise your credit score. Lenders are one of the best people to help you raise your credit score. They can look at it and tell you exactly, if you pay off this credit card, your credit score is going to go up 50 points. If you pay off this, you know, maybe you have like, I don't know, what do you, like a judgment or maybe a,
Yeah, our small medical collections I'll see a lot.
yes.
Things that people
So,
don't realize are on their credit,
yes.
are dragging their score down. So
Yep. I just had a client who her credit score was brought down by a $200 payment from a student loan payment from a school she got her master's degree from. And it brought her score down so much she didn't even realize it was there, had no clue. So you're not wasting anyone's time. I have clients I work with for over a year before I end up selling them a house. That's part of the process for us. We don't care. We are more than happy. If you come across a realtor who doesn't give you the time of day, well, you shouldn't want to work with them anyways, because
yeah.
every realtor knows this is a marathon, not a sprint. We are here to create relationships for life. And we are hoping that by serving you, you then will refer us to your friends and family. So, all right, let's see. We've got a couple here in the chat. So, how much does it cost to talk to a lender?
So it doesn't cost anything. That's part of our job. Of course, my dogs start barking right when I talk. So yeah, like I work with people like Marissa's saying for a long period of time. We're just here, like we don't charge you, I guess is the best way to put it. And then I see the second question with student loans. And right now, all the loans, if they're federal, are in deferment, and basically we're using a 1% payment of the total amount unless the borrower shows us the actual payment. I had a client who was his loans were not being paid, and we still did the loan. So it's really, it doesn't mean like, so if someone has student loans that they're not making payments or are in forbearance with, it doesn't mean they cannot buy a house. So I hope that makes sense. But that's why it's a very one-on-one conversation depending on the scenario. But don't count yourself out without talking to a lender first. And if a lender does charge you, then don't go to that lender.
Yeah, they shouldn't be charging you. I have heard before at some of the bigger banks where a client has told me, oh, well, they made me pay like a couple $100 for an application fee.
Yeah.
And I always say to them, that's kind of silly because
sometimes we previously, like, to have a conversation, we wouldn't, but like I've heard where once you're in process, like when you have a property, they may collect funds up front. We don't currently do that. We have in the past. So it's just a way of keeping, because how I said to shop, the counter to that is then if we're paying, because we pay for the appraisal as a lender up front and then just charge it at the close of the loan. So we want to make sure people aren't just, playing each other off each other, and then we're spending $600 in appraisal and they go with another lender. But yeah,
that's much further in the process that
yeah,
you would be.
as far as just trying to figure out where you are, like with like financially what you can afford, there's no cost for that.
Yes. And then, so for, we have a question in here about a VA loan. So for VA loans, they are one of the most flexible loans. They're one of the easiest loans to get because you can have one of the lowest credit scores with them, and they go up to one of the highest debt to income ratios. VA loans are calculated a little different than conventional and FHA loans. They want to see your residual income, and there's a formula for that. My mother, who's also a lender, as well as my sister, my mother is a broker and she does all the government loans. So she does all my VA loans. And basically, it's a very similar process to what Kara explained. The only difference is there's just a little formula where they look at your income, and based on that, then they're able to tell you how much you're able to go up to. But you are able to go up to a 65% debt to income ratio generally, which is huge for people who maybe have income that they don't show as much, or they have their own business or what have you.
Yeah, and for like, so the 65, normally we want 45, 50s like the top. My company will go higher, but then your interest rate gets higher. What's great with the Veterans Association loan is that they have such low rates. So if you have any family members that aren't taking advantage of that, like I would tell you to urge them. We don't currently do VA. We're working on getting it. COVID kind of slowed down a lot of our initiatives. But it's definitely like, I feel sad when I see people not taking advantage of that loan.
And there's no PMI on a VA loan. So you can put 0% down and you have no PMI at all. You can put down 20% if you wanted to on your VA loan, what have you, but you can put down as little as nothing and have no PMI, which is huge. Let's see. So how long a time period should a first-time home buyer be looking at for their home of choice? What fits now, 5 years, 10 years, for life? Okay, so first-time home buyers, the reality is most homeowners live in their house 5 to 7 years. First-time home buyers usually live a little bit closer to the 3 to 5 years because you're getting your feet wet. It's really more important to get in the market. So the market out here last year in Ventura County appreciated 14%. So had you had your feet in real estate, you just made 14% on your money. So that's the most important part, is getting in the game, getting in wherever you can, whether it's a condo, whether it's a smaller house that's not exactly your forever home. You know, my first house was not my forever home. It was a 2-story. I'm now in a 1-story. My kids don't understand that, but I worked really hard to get into a 1-story. They think it's really cool to have a 2-story. So you get in wherever you can. And whatever that looks like, you know what? It's yours. You own it. You're stabilizing your housing costs. And with California real estate, you really can't go wrong. I mean, you're going to make money on it. I think we're going to hopefully come into some flat years coming up, because we don't want the market to just keep appreciating double digit. That's too much. And we did see that. We've had a few really big years, and then it kind of flattens out and chills out a little bit, which makes it a lot easier for buyers to get in. But I think that these low interest rates, though, are definitely driving people to take advantage and get in, because you're locking in below 4% at minimum. Some people are in the 2s for 30 years, which is just crazy. So we have another question here. Are there still programs that help first-time home buyers? There is a Cal FHA program that does help, and you can do a 1% down loan if you are not a veteran and don't have that. It is a little bit longer of a process. I've done a couple of them. They're not as familiar, but not as many people do them. They're not as competitive, so it would be a little bit more difficult in this market to get accepted. But an FHA loan, and Kara, don't you have a 3% down conventional loan?
Yeah, I was going to say we have 3%, and we just started doing another loan program with 3% down. That's a little more flexible. So 3%, if you're trying to buy a $500,000 home, you need 15,000 down. I have to double check because they just announced on this loan program. It also has a no cost option, which is great, because even with 3% down, my first home, we put 3% down, but ended up, I think that home was around 500,000. So the 3% would have been 15,000, but our total out of pocket ended up being 32 with everything, because we had to have impounds, etc. So,
and you had the PMI upfront fee, which is 1%.
So it depends. That was an FHA loan on the first one, but that would be the biggest help, is just the lower down payment. And it's not specific to first time buyers. It's available to anyone. But yeah, that would be the best route. And I'm hoping we're offering that on the no cost program, because then the buyer would only have to pay their prepaids plus the down payment, which the prepaids again were the homeowner's insurance, taxes, etc.
Yeah, and you can use retirement funds as well. Some people don't know that. So if you've been saving in your 401k, you can use those funds for your down payment. And I think you don't pay, depending on the plan, you don't pay penalties on it. You do pay taxes on the money you take out.
But you
but
can
you
also
don't.
sometimes take a loan.
Yeah, you can also do that too, where you can take a loan from yours and then you don't pay penalties or taxes because you end up just paying that back.
And typically the term's 15 years. So the payment, like say you have a 401k and you have whatever $50,000 in there. I think you can only use like 50% of it. You have to look at your specific plan
Mhm.
if you're doing the loan. And then so that's one way where the loan, you're not liquidating it. So it's still, in your retirement and you're paying it back over time. Some plans don't offer that, but Marissa's correct. Like you can use your retirement funds for a down payment and avoid the 10% early withdrawal penalty.
Yeah, which is I mean, I've had a lot of clients do that because that's where they were able to save their money over time. And you're trading it from one investment class to another. So it still can benefit you for your retirement because you're building that equity in your home and you're
Yeah.
stabilizing your rental costs or your housing costs, which is huge because I'm sure if you're renting right now, unless you have a really nice landlord,
Yeah.
rents have gone up ridiculous. All right, so we have another question here. It says, is it common for people to talk to their financial advisor before meeting a lender, especially if you're thinking of taking from your 401k? It is depending on if you have like a personal financial advisor. I know people who do meet with their financial advisor and let them know, the stock market's gone up a lot over the last couple of years. So that is a great way to take out if you have money in there and put it, take some of those gains basically, and then put it into real estate and owning your own home. So you can, for sure, financial advisors are usually, if you don't already own a home, want you to have that diversity within your portfolio. So I've never met a financial advisor who tried to sway someone not to buy a home. So what?
I said they exist. I would say with a 401k, that's through a company if you still have it with the company. So you could, I don't know, it would depend on if whoever is the entity, like for my company, it's Transamerica does ours. I know they do have where you can speak with a retirement advisor through that as a service. Typically people are going to have a financial advisor if they've left the company and rolled it over. So if you have rolled your 401k over into an IRA and you have someone who's managing that, I think it's a great idea to speak with that person and get, more qualified opinions about what to do with your money,
Yeah. Let's see. Is there anything else in here that we didn't answer? I think that's really it. Does anybody else? Anybody else have any other questions? And you're more than welcome to unmute yourself if you wanted to for, this portion, if you want to just ask a question. Oh, Kara, can you share your info again? Maybe you can share your screen with your contact information. Yeah, and so Kara too, with my mom, they refer loans back and forth to each other. So if you meet with Kara and Kara realizes that maybe she doesn't have a loan program for you, because maybe it's better for you to go FHA, she is able to refer you to my mom as well and say, you know what, you really would be better in an FHA program, and vice versa. So it's kind of nice that she has a lot of knowledge about those government loans in case something they would better serve you than something at the credit union. So, but that's it. So I hope you guys found this informational. And if you have any further questions, please feel free to reach out to whoever invited you, or you're more than welcome to contact us. I think probably should have our contact information here, huh?
It's our first seminar.
Sorry, but I hope you guys.
Thank you for being a guinea pig.
Yeah, thank you. I hope you guys found it educational. All
Bye,
right.
everyone. Have a great evening.
Have a great night. Enjoy the rest of your evening. Bye. We're still recording.